Success, creating wealth, taking care of your loved ones doesn't happen by accident. It takes planning. Hello, everyone, and welcome back to Insure Wealth. We're really fortunate today to have with us again Howard Kaye to tell us what's involved with estate planning. Hi, Howard.
Hello, Michelle. Again, it's great to be here today.
It's great to have you.
Thank you.
Now, let's get right to it. Can you tell us what is estate planning?
Absolutely. I mean, in its simplest form, it's being in a position to transfer down your assets to the next generation or to charity or to wherever you want it to go. Just like the words say, estate planning, how to plan your estate. And, you know, this includes your art, your home, so many different things. What people don't realize is how devastating it could be if you don't plan. And I only use one quick example. I remember years ago, in fact, when I was a little boy, we had advertisements running in Architectural Digest. And it was beautiful Ming vases and just different tremendous estate pieces. And there'd be a split down the middle. And it said, this half stays in your estate, this half goes to Uncle Sam. And what better way to discuss estate planning?
Now, Howard, I've heard about people whose estates are decimated, that they get reduced by a lot. What happens in that situation?
You know, unfortunately, Michelle, that is true. People's estates do get decimated, but it doesn't have to be that way. You know, I'm going to give you some examples of what can happen, but, you know, it really comes down to what someone's definition of estate planning is. Because people will go to their attorney, as they should, to have their wills drawn up, trust, and other things of that nature. But if you ask, what is their definition of estate planning? It's reducing the size of the estate, which thereby reduces the ultimate taxes that are due. Well, I'm not interested in the amount of taxes that have to be paid. I'm interested in one thing, and this really defines what my definition of estate planning is, which is very simple. Leaving the most amount of money to my heirs and favorite charity. If I have to pay more in income tax to leave more to my family, that's fine. Now, when we talk about the decimation of estates, who are we really talking about? Well, first of all, you have to understand there's certain exemptions that exist within estate planning as far as when you become taxed. But let's just forget exemptions for the moment because nobody knows when they're going to pass away.
Right.
And at any moment, the exemption could be $5 million per person, as it is right now, or it could be $1 million, or it could be $3 million. Who knows what it will be when we pass away? But who really become affected? It's the people that don't have the liquidity to leave the estate. Now, what do I mean by this? Take small business owners. These are people that have amassed a sizable estate, not because they're living so beautifully or enjoying all the fruits of their labor, but because they've built up a business and all their money goes back into that business and the business has value. But unfortunately, they died prior to them expecting to die. They passed away prematurely. And now that business has real assets, but the government comes in and says, you may owe 50% of the value or 45% of the value of that business in taxes. What is someone to do? Are they supposed to sell the business? Take a farmer in the Midwest. They've created tremendous crop. They've built up that land. The value of the land goes up. But is that cash in their pocket? No. What happens when they make a mistake and pass away? They want to transfer the land to their family, but who's going to pay the huge taxes that need to be paid on that land? They don't have the money.
I mean, these are examples, they're heartbreaking examples. What you're saying is it doesn't have to be that way.
It doesn't have to
So
be
how
that
do
way.
these, for example, these two examples, the small business owner and the farmer, how do they avoid having this heartbreaking situation happen?
Well, it's, again, very simple, and we talk about it each week. I know people don't like hearing the words, but it is what it is. It's called life insurance. Life insurance. It is the only product that creates the money needed at the time it's needed most. And when is that? It's when death occurs.
Right.
The government gives us 9 months to pay our estate taxes. Well, the life insurance company pays off immediately. That's where you receive the money to be utilized to pay the tax.
Well, let me ask you a question. Is life insurance part of an estate?
Very good question. Life insurance, as is any product for that regard, is not estate taxable or is not estate taxable. What do I mean by that? What defines what is part of your estate is what you own. So, for example, the clothes that you're wearing today, the jewelry, that's something that's personal items. You own that.
Right.
That's part of your estate. Your car that you drove here in is part of your estate. The house that you live in, if it's in your name or your husband's name, that's part of your estate. If you have investments and they're titled in your name, that's part of your estate. However, if you have a life insurance policy that you own or your husband owns, that is part of your estate. However, if it is not owned by you, and it is owned by an irrevocable life insurance trust, or owned by your children, or owned by a charity, as an example.
It's outside of the estate, and it's outside of estate taxes.
Absolutely.
See, eventually I get it.
You're learning.
Okay,
And
all right.
you know what? I'll tell you, this is a question that is probably one of the most frequently asked questions, because people don't realize it's not the product that defines whether it's estate taxable. It's the title of the assets. How are those assets owned? So again, anything that is owned by you is part of your estate. Anything that is not owned by you is not part of your estate.
So are there legal ways to reduce the size of an estate?
Well, absolutely. And this is where a good estate planning attorney will show their clients exactly how to do that. There's approaches that can be utilized with charity, where people can receive income during their lifetime, but the bulk of money goes to charity at death. There are approaches where somebody can be living in their home, but each year a piece of it is gifted to the children. There are ways that parents, as they get older, will start making larger gifts. They may start to pay for their grandchildren's education, for example.
Right.
And again, that's ways of reducing the size of the estate. But again, I'm not so concerned about reducing the estate as I am leaving the most money. Another category of individuals that would fall into the example I gave earlier is people that are heavily invested in real estate. They've amassed a sizable fortune in whether it's commercial property or residential, whatever it may be, and they make a mistake and pass away. Well, guess what? The government comes and says, well, you own it. It's all part of your estate.
Right.
We want the money to pay the taxes. Well, where does someone get that money from if they're illiquid? And that's typically when someone will have a fire sale. You'll see the kids come in and say, we need the money. We got to sell whatever we can at whatever price.
And they sell it, and it's undervalued because people take advantage of that situation.
Absolutely.
Right.
You know, that's the time to strike. Well, I'll never forget, there was a story years ago when I was out in Los Angeles. One of the big, I don't even remember what you called them anymore. There was the big 10 accounting firms, the big 7, the big 5.
The numbers have changed.
They keep merging.
Right.
But anyway, this was one of the major accounting firms across the country. And I'll never forget, I had a client in Los Angeles, and he had a net worth of $10 million. And in discussing with him, his attorney, and his accountant, we determined to buy $5 million of insurance to help offset those estate taxes that were going to be due. Because think about this. By having the $5 million of life insurance in hand, that would be paid to the children tax-free, and the children could use that to pay the ultimate tax.
Right.
And they needed this. Why? Because the man was loaded with real estate, and this was a liquidity position for him to be able to create that liquidity. Now, at the same time, it was fascinating to me. He referred a friend of his in Philadelphia. The friend happened to use the same accounting firm in Philly. And when speaking with the friend, who actually had the similar size estate, the friend says, "Thank you, we're all set, we don't need insurance." And I said to him, "Why?" And he said, "Well, I'm with my accountant right now, and what we've been discussing is that I'm very liquid. I don't need the insurance.
Okay.
Now, what I thought was fascinating was here it's the same accounting firm. You've got Philly and you've got Los Angeles. Do both cities not speak to each other from the same firm with the same advice?
Doesn't make sense.
Makes no sense. Now, which child would you like to be? The child of the Los Angeles person or the Philly person? Well, it's very simple.
Right, of
the
course.
Los Angeles person. Why? You see, this wonderful accountant and client in Philly who has a net worth of $10 million, who is liquid and has all the money in the world at his fingertips, will die one day. And when he does, the children will get $10 million, and then within seconds, poof,
It's gone.
the money goes. And guess what they're left with? $5 million. Now, that's certainly nothing to cry about. That's okay. They got $5 million.
Right.
But let's talk about the person in Los Angeles. You see, the person in Los Angeles was very unfortunate. He had real estate. He had no liquidity. So his accountant told him that he must buy life insurance. So they bought $5 million of life insurance. And now what happens? He dies. The real estate is passed to the kids.
They can pay the estate taxes.
$5 million is owed. But what came in? $5 million of life insurance,
Right.
completely tax-free, enough to pay the taxes. Now
Now they have their property.
They have their property. $10 million, as opposed to the family in Philly, is left with $5 million. Fascinating. Same accounting firm, two accountants with completely different thoughts, that it made sense for the person that's worth $10 million in real estate should leave $10 million of real estate to the family, but the gentleman with $10 million of liquid assets should only leave $5 million to the family. Tell me where that planning makes sense.
What other ways are there to purchase life insurance?
Well, the other ways are really just situational. You know, if you ask, well, why would somebody buy, we just learned about the person that was illiquid, who had real estate. We learned about the person that had cash, who was liquid, but was given bad advice.
Right.
He should have bought insurance. What other reasons are there that people would be buying? Well, you want to leave a legacy. You're not even concerned about estate planning. I don't care what the reason is, but you want to leave a legacy. You want to make an impact to your children, to your grandchildren. You want to make an impact to a university, to maybe your alma mater. You want to make an impact to the industry that you created your wealth within. Well, you can do that. You know, I had my daughter on a show previously, and the show was about legacy. And I asked her, do you understand what life insurance is? And she said to me in her sweet voice, well, it just means when you die, the insurance company pays us money. I said,
Right.
That's absolutely correct. I said, but let me tell you about legacy, why it's so important. You see, I realized that I could create a trust, and I could set up life insurance within that trust that is for her benefit, but having to do with goals that are set for her. So for example, in this case, she wants to be a veterinarian, but who knows whether that's really going to be her path. I think she just wants to be helpful to animals all over the world. She may be involved with a charity one day. She may be traveling over the world giving medical help to all these animals. Now we know, being involved in charity, there's no money to
Right.
be made, but this is her passion, what she wants to do. Well, I can set certain goals within this trust when you reach 25, 30, 35, and with the life insurance within the trust, free up money for her so that she doesn't have to worry about whether she's making enough money being involved with the organization she is. She is still someone that seeks success. She's got a passion, a zest for living, going out and making a difference in this world, and she can be rewarded through the life insurance. Someone
Right.
that's a school teacher, we know how important they are to our children, but they
course.
don't necessarily make the money. But do you know what I can do by leaving a legacy to a union for teachers or for whatever it is that I want to be studied by kids, that these teachers are devoting themselves to it and they're going to reap the benefits because I was able to create some type of endowment for them. That's the other ways that life insurance
Right.
can be used.
Well, some people think that they can't afford life insurance, that this is something that's sort of beyond their means. So, I mean, what do you tell
Well,
them? How do you deal with those
You
types
know,
of people?
the truth is that we all can afford life insurance when we're talking about the estate planning and why. You see, people look at life insurance as an expense, but it isn't. Now, I understand you are used to paying insurance for your car,
Right.
for your home, for jewelry, for fire, for wind, hurricane,
Flood.
flood,
You name
everything.
it. You name it.
And if you were to think about the thousands upon thousands of dollars that you spend each and every year, tell me how much comes back to you.
Nothing.
Nothing. Right. Unless you put a claim in. And how often do you put a claim in?
Rarely.
Exactly. So it's a throwaway, meaning that I've got to have it, I got to spend the money, but we're praying that I never have to use it.
Right.
What a business.
Yeah.
Is that unbelievable? But with life insurance, I'm paying a premium, but we are guaranteed to get paid because you have to die. Everybody has to die.
So it's not a throwaway.
It's not a throwaway, and why I say it is not an expense is the couple that's age 70, that each $1 million of insurance may cost $14,000 or $15,000 a year. If they were to take that money and put $15,000 a year into the stock market, for example, do you think they think to themselves, oh my, look at the expense of the stock market?
No.
No, it's an investment,
Right.
right? Now, will the stock market guarantee that as long as you give us $15,000 each and every year, we're going to give you back $1 million when you die?
I wish.
But they don't.
No, they don't.
So why is life insurance an expense, but the money I put in the market or into bonds or into treasuries or into the CDs, that's not. That's an investment. Now, I can't call life insurance an investment. It's not allowed. So forget the word. We created a phrase, the investment alternative.
Right.
But forget that even. You tell me, if I put $15,000 a year into something and somebody pays me back $1 million ultimately when I'm dead, I don't know what else to call it, but it's a hell of a return on your money.
So why is there a negative connotation?
Well, because we're talking about our own mortality.
Right.
People don't want to talk about death, but as you get older, people realize it is a fact of life, and that's when people do start really looking into it. Also, I will tell you, it depends on the industries people come from. Entrepreneurs who have amassed a tremendous amount of money at a young age realize what it took, the luck that they had, being at the right place at the right time, the hard work that they put in, the idea, the creativity
Right.
that they were able to produce and communicate to the public to make their ideas work. They don't want that forgotten. They want a legacy. They want to be able to further whatever they've created. Again, that's where life insurance. I'll tell you, it was one situation of two educators. They were high school principals in New York. These people never made more than $80,000 a year. Now, that's not to say that's not wonderful. They were educators and they were doing a tremendous job. But they were making $80,000 a year. Do you know that because of the timing and the way the market was doing and the rich pensions that New York had, they amassed $15 million
Wow.
as a result of the investing throughout the years. They retired. Now, in speaking with them, what was the money? What did it mean to them? It meant nothing. It was security. What did they live on each year? No more than $50,000 to $70,000. So we were talking about what could be done, and we talked about purchasing life insurance. During that period of time is when the market crashed back in '08.
Oh, no.
The man came in to me, he said, Howard, I'm frozen. I can't do a thing. I said, why not? He said, because my 15 million is now 10.
Wow.
I said, well, that's a third that you've lost. He said, yes. I said, do you realize that in order to make it back, you need to make 50% on your money? Because now you got to make 5 to get back to 15. And he says to me, well, I don't know what I'm going to do. He said, but I can't afford the insurance. I said, it's an interesting way you phrase that. You can't afford the insurance. I said, you've done a tremendous job your whole life educating people, right? He said, yes. I said, I'm going to help educate you now. Because this is what's going to happen. Your $10 million estate, which you can't believe, you're mortified, you just lost $5 million. You're going to say, it can't be true. I'm going to get it back. So you're going to have staying power. You're going to stay in the market. And what's going to happen is the market's going down to 9.
And you're going to lose more.
You're going to lose. It's going to go to 9 to 8. And then at that point, you're going to get so afraid, you're going to get out and say, I can't take it. So you're in store for probably another $2 million. Whereas, if I say to you right now, you want to recoup your loss, it's very simple. What we're going to do out of your $10 million is you're going to create $100,000 a year. And you're going to give me $100,000 a year, and we're going to create $5 million of insurance. And in 2 seconds, I just recreated the $5 million that you lost. I said, but you're not going to listen to me. You're going to stay your way in the market, and we'll see what happens. I said, now what's even more fascinating to me is this. You live on 50 or 60,000. Do you realize that you could afford to lose everything down to $2 million and you'd still have enough income to live on? And you're concerned whether it's 15 million or 10 million, but if it goes to 7, you won't even know what to do with yourself.
So you reframed it for him. Did he understand?
Yes, we recreated those assets that he lost through the use of life insurance. One other idea that's on that same topic, where I've had people that have said to me, we just hit it big. Company came in, bought our business.
Right.
And now we want to enjoy, but we want to be able to leave money for our children, but not at the expense of our lifestyle. Remember something. We have so much time to live. Our children have this much time, and our grandchildren have this much time. So, while we want to do everything that we can for our children and our grandchildren, at the end of the day, we come first. We're here the shortest period of time.
Right.
But I also want to know what I've created for my children. Well, in this manner, I can buy the amount of insurance that I sold my business for. So this gentleman told me how he sold his hotel business for $24 million. He said, I want to give to charity, I want to live high, I want to do everything I've always dreamed of, but I want to make sure my children receive money. So what did we do? We bought $24 million of insurance on he and his wife. How much money did that cost him each year? Cost him around $700,000 a year for $24 million. They were in their later 70s. Now, is that a lot of money? Sure it is.
That's a lot.
But what does he make on his money? He was making about $1.5 million a year from bonds and tax-free. And the bottom line was for him to come up with $700,000 a year to make sure that $24 million would be received by his children one day and by charity is what he wanted. And he also knew that he could spend every last dollar and it wouldn't affect what his children ultimately receive. That's replacing your estate with life insurance.
And it's comforting, obviously, someone like him and most people, knowing that you can live the way you want to live, but you're still protecting the future for your children or for your favorite charity.
Now, I do know that you're going to ask me probably, what about the person that doesn't have $24 million?
Like me.
What about the person that's just working? Maybe, here's the best example. Years ago, I'm in a barber shop, and a manicurist is sitting there, and she's telling me about how she's putting money away for her child for college and everything. And she's so concerned for her daughter. And I said, do you realize that you could take some of the money that you've put into your retirement for savings? We could use some of this money, and I can create for you $250,000 that ultimately will be received by your daughter. When she saw that it came from money that would not affect her lifestyle in any way,
it was comforting.
That was, not only was it comforting, she was elated that she could do this. She never in her wildest dreams thought that she'd be able to create $250,000 for her daughter. And all of a sudden, you mean I can do this with life insurance? And I've never been one to go out and seek it out because I've always assumed it's too expensive. I can't afford it. I don't qualify. You have to be rich for it. No. You just have to ask questions.
Well, what about annuities? Are they part of an estate plan?
Again, it all falls to who owns the product. So yes, if you own the annuity or if you have an annuity in your retirement account, that is part of your estate. Okay. And unfortunately, annuities are taxed similarly to retirement plans because whatever you put in, the growth is tax deferred. So you've never paid income tax. So at death, you have to pay income tax and then you have to pay estate tax on that money. So with people that have annuities,
right,
if they need income, that's wonderful. But if they don't need income, that's where I like to show people how to utilize the growth each year
right,
from an annuity and buy life insurance so that ultimately that money all becomes completely tax-free.
Howard, I still have so many more questions, but let me ask you, is it possible to leave your estate to your favorite charity and to your children?
Yes, in fact, it's something that we created called Give Your Estate Away Twice. Really what it involves is creating life insurance outside the estate for the benefit of the kids, and knowing that everything that's left in your estate, you don't need to leave them anymore because you recreated your estate one time already outside, and now the money that's left in your estate when you die, give it to charity, there's no tax, and I gave my estate away twice.
Howard, this is a lot of information, a lot to think about, and more to know. And there's more information available at 561-417-5883 and at insurewealthtv.com. Thank you so much for being here today, Howard.
Michelle, it's always a pleasure. Thank you.
And we'll see you again next Tuesday, same time, for Insure Wealth with Howard Kaye. I'm Michelle Suskauer. So long.